Excellent. Welcome everybody to, I think this is the 10th no BondCast that we've held here at Beck Bodie. It is, well, a lot's happened this year. Jim's going to take us through that in a second, but I wanted to reintroduce myself to anybody that doesn't know who we are. My name is Ben Beck. I'm the co-managing partner and chief investment officer of Beck Bodie. And with me today is my co-managing partner, co-founder of the firm, Jim Bodie. And today we're going to be talking about a number of topics related to finance, related to our company, related to current events. Before we get started that, I just wanted to welcome everybody and then I'll introduce Jim to take us through a little bit of information first, and then we'll dive right into today's subject matter.
Perfect. Thanks, Ben. And as we get things off and running, just anybody who's watching this right now through Zoom, if you go to the bottom of your screen and you click the chat button and have a specific question you want to make sure we cover, please type it into there and we'll do our best to get to everything. For those of you who emailed us questions, we did receive them and hopefully we cover them all along the way. But as Ben mentioned, this is, I believe, our 10th No BondCast. And we've covered topics along the way, such as estate planning and college planning, nutrition, and we are scheduled to continue these types of topics the second Thursday at 3 p.m. of every month. And next month, our topic is going to be along year-end budgeting, and then into January, talking more about goal setting and financial planning. So you can mark your calendar the second Thursday of every month at 3 p.m. We'll continue our No BondCast. But this has been one remarkable year, 2020. And we've seen, obviously, we look at the beginning of the year and the markets where we're off and running great. And then comes March and things kind of came to a standstill, obviously, when we started learning more about COVID and how it was affecting our economy. And Ben, I'd love to have you take us through real quick, kind of a year in review up into where we are today, just kind of with the markets, what we've experienced, maybe why we've seen some of the things we have during the year this year.
Sure. And I remember, certainly wasn't that long ago, but I remember very clearly when everything really started to turn in the negative direction with respect to the economic response to what at the time we thought was a potential threat. Mm-hmm. And this was back at the end of February. And I remember that because I was actually out on the West Coast for a few days in Los Angeles at a business meeting. And it was just that week where there was a lot of talk about infections in the United States and the subsequent and potential subsequent effects it will have on the economy if it exacerbates. And certainly that week, we started to see those huge down days in the markets as a lot of fear came a lot closer, in terms of what we could potentially go through. And then certainly a few weeks after that, we started to see a lot of schools shutting down, right? We all know that. A lot of us at Beck Bodie here have school-age children and who are now home, remote learning.
Going well.
We won't get into that. Doing well, exactly. No, but we've a lot of schools have gone to a hybrid, as a lot of us know here, a hybrid mix. So, and that's a good example of how over the course of time since earlier this year, the world has dealt with this virus and such, and has made do, in terms of look at what we're on right now in terms of Zoom, and have been throughout the spring and summer, and conducting business. And in light of an a pretty significant economic shutdown to slow the growth of the virus, mm-hmm. Us here, particularly in the US, I think have done a very good job of adapting and use a football term, calling an audible and going in different directions here based upon what we see in front of us. And I think that's a good way to clarify how the markets have responded throughout this year, in a sense that, of course, the markets more than anything else hate uncertainty. And that's exactly what was thrown upon us late February and early March. I think we saw the bottom March 20th, I think it was, or 23rd, somewhere around there. And so we saw a substantial decline, and the substantial decline, not only was it substantial, but it was over a very short time period, over the course of just a few weeks, where we saw a decline that wasn't the worst in history, but it was one of the worst within that short amount of time. And then as we've worked things out, I think, Jim, you and I on these podcasts prior had, when getting the question, the $100 million question, which was at the time, how much is the market going to drop, and for how long is this going to last? And while we didn't have the answers to those questions, nobody did. What we felt very strongly about, judging from what was causing this shutdown, was that when we do see a glimmer of light, then the recovery of the market we expect to be nothing short of epic. And what we saw, I think, probably surprised us in terms of how early it recovered, but the velocity of the recovery was one that was substantial and was welcome, obviously, by anybody investing.
Yeah, and you've said that going back into our first podcast, webcast, was the word epic recovery. You've repeated that over and over to our team, and I've heard you say it to many clients. And I'm not sure that while you were saying it, that you knew it was going to happen this quickly. So it wasn't a matter of if it was going to be epic. It was a matter of when that epic recovery was going to start. And I remember sitting in our investment committee meetings early on, and you kept saying it's going to be epic, stay the path. And that's the same exact message we have passed on to all of our clients along the way. And we all like to be right, especially very soon after we say something and make a statement like that, an epic recovery. So why, not necessarily of why did we have an epic recovery, but internally at Beck Bodie, why did our portfolios have any sort of an epic recovery in the manner that they did?
Yeah, well, I will say that the genesis of that comment, so to speak, is that because it was something that we were facing, that not that we understood the virus at that time, and we're still learning every day, but we understood the reason why the market was falling. There was, and we look back to another market crash, 2008 and 2009, where that was a gradual learning process of what the heck was going on. Late 2007, the market started correcting a little bit. The common buzzword, I know you remember, Jim, was, oh, well, the economy is in for a soft landing, a soft landing. That was the buzz phrase that was repeated over and over and over again at that time period. It wasn't a soft landing, as we all know. It was a crash. And we didn't really learn what it was that caused that as investors until deep into, or a little bit later into 2008, when we started to see financial institutions collapse, like Bear Stearns, Lehman Brothers, and so on and so forth. This was different in the sense that we knew exactly what was causing the market reaction because of an economic shutdown as a result of the spreading of the virus. So our thought process was, depending on how long this stretches out, the more we learn the near term, and the more we can see the light at the end of the tunnel in terms of at least starting to get back to work and regenerating the economy, things should snap back, and they did. Our portfolios, which I think is your original question, if you're a client of ours, and we had conversations like we did with a lot of our clients throughout that time till today, you've heard a broken record, right? Jim just said it. Stay the course, stay the course, stay the course. We don't change our investment philosophy based upon something that may have happened yesterday, or we expect to have, not that we expect anything to happen tomorrow. Our process that we employ is time tested. It's not perfect. No investment strategy out there is. But we, as well as our investors, our clients, understand the inputs. They understand the discipline on why we do what we do. What do we buy? When do we sell? Where do we reinvest? We know the importance of having some of the best research, some of the best Wall Street analysis on the companies that we're identifying at our fingertips. We often say that your portfolio performance is only as good as the quality of the information that you have at your fingertips. Really important. And then the most overlooked part of the strategy, many investment strategies, this concept of patience. Very simple to say, but very difficult to exercise, especially during times like we've gone through over the past year. How do you not feel the need to make changes in light of the sky falling, on our heads, in real time? And it was just another reminder how important, or it's a reminder now, looking back, how incredibly important it is to exercise those key tenets of the strategy, patience being a big one, so that you don't react emotionally, because the markets over the time tend to recover, and they recover substantially. And our client portfolios have benefited substantially. Our clients benefited substantially by staying put, given that they had, which they do have, a very well-structured philosophy being employed and a qualified team in able to execute on that.
Can you talk a little bit more about some of those changes? I think it's important to realize that when you say that we don't just sit there and wait, that the changes that we made going back into March, into April, into May, and will continue throughout this year, were all based on research. They're all based on where we think companies are headed and who we think is going to navigate the current environment the best over the next 12 to 24 months. Can you give us a couple examples of a few of those companies that we either were buying into at the middle of this COVID crash, we'll call it, and which ones we were selling out of and why?
Sure. Yeah, I won't get too deep into the details of each specific company because we only have a little bit of time here. But there's conversations, of course, as an investment committee that we're having at all times, and certainly during times like we went through. And again, it underscores the importance of our strategy and always looking ahead of in what the analysts are saying about the future. There's a ton of information out there about a lot of companies on Wall Street and what they've done in the past. There's a lot less information out there about companies, or less quality information about what is expected in the future from these companies. But that's what we focus on. It's so incredibly important to focus on, despite what may be happening today, what do some of the top minds on Wall Street expect to happen 12, 18, 24 months from now? Like it or not, you know this, Jim, we know this, like it or not, what determines the value of your portfolio, good or bad, happens tomorrow, not today. So we have to look to the future to understand perhaps what direction that these companies are going in. The flip side, or the catch-22 there, is the fact that what we think today, we're going to think differently tomorrow, right? So we have to have an element of our strategy that, call it humility, call it accommodates for understanding that we're going to be wrong at some point. However positive we may feel about a company today or negative, we may in fact think very differently of that company 6 months from now. And so these conversations that we had especially in that March, April timeframe, there are a lot of great companies out there in the markets that had just gotten hammered. I mean, the entire market corrected. There were certain companies that we had in the portfolio that we continue to invest in, new companies that we chose to invest in. So a few that come to mind are Lululemon, a retailer, by the way. So nobody was going into the stores, right? Everything was shut down. We chose to hang on and reinvest in a company like Lululemon for a number of factors. Number one, we were getting a lot of analysis in terms of, while all stores were shut down, their online sales were at or greater than expected holiday sales at that time. And that continued for quite a while. So that told us that while yes, revenues certainly by just the effect of a shutdown were going to be impacted, we also looked a little bit deeper into the analysis and saw that, wow, these holiday-sized jumps in activity in terms of online sales were going to be able to carry the company into the future, where a number of other retailers perhaps are not as nimble or not set up like that, and subsequently did not do well. Dunkin' Brands was another company that we own, owner of Dunkin' Donuts and Baskin Robbins, who more recently, if you're a client of ours, a number of our clients own Dunkin' Brands, which more recently was announced that it was going to be taken private by another company. That company dropped as low as in the mid 30s, if I'm not mistaken, down from perhaps $70 a share. So a substantial decline. But similarly to Lululemon, different kind of industry, obviously, food and beverage and such, coffee. But a lot of the research that we were looking at was talking about, in terms of drive-throughs, accessibility, sustainability, a lot of positive factors to counterbalance what was negatively going on in the world. So those are two examples of companies that we did own at the time, and perhaps what we're on right now was an example of something we bought at that time, which was Zoom. And Zoom had already experienced a pretty significant upswing by the time that we had bought it. But again, we don't look at price. We don't look at anything in the past to make decisions about how we invest. We're always looking at the future and what's expected. And as a result, in a good part by the pandemic, but also how the pandemic has shifted our thought process business-wise on how business will be conducted in a lot of ways going forward. Mm-hmm. Zoom was one we bought into, which has had a substantial increase since then. And again, it underscores with all three of these the importance of looking forward and not looking in the past.
Yeah. So as Chief Investment Officer for Beck Bodie, do you think you're a great stock picker?
We're not, you know that, Jim. That's a setup. We're not stock pickers, right? Yes, we identify, we pick stocks as a committee for our clients' portfolios. No question about it. Right. But the intention, I know, of that question is the fact that that conjures up the image of selecting a stock based upon, oh, I'm going to get in for a quick move and get out, move into something else, and be more of a trading mentality. We as a firm are interested in owning a stock today and still owning that stock 3 years from now after it's gone up 400% or 800% or 1,000%. And if there are some people watching this right now that say, well, that's once in a lifetime to find a company like that, I understand where you're coming from, but you're dead wrong, because a lot of folks don't own individual stocks. They own mutual funds, index funds, where they don't really see the inner workings, the movements of the stocks within those portfolios. Right. So they don't get to experience in the true nature of owning the individual holding and seeing that, hey, there are companies today that may not be mainstream name brand companies that perhaps 3 or 4 years from now will be Main Street type of companies that have gone up substantially. So we don't fashion ourselves as stock pickers. We invest in a process, right? And that's what our clients invest in. They come to us because we have a process that is simple to understand. It's founded in some very, very important, it's a very, very important discipline, as we've talked about, in terms of answering those 3 questions, having the best research at our fingertips, and of course, the exercising the right amount of patience.
Yeah, and obviously you smiled as I asked you that, but that's exactly right. Is our investment processes lead us to the investment decisions that we make on behalf of our clients. Mm. One of the questions that I have been getting a lot is, were we able to, in our portfolios, to stay as diversified as necessary? As many of you know on the call, or people that we've talked to know, that in our portfolios on the growth side, we own 15 individual holdings, and we diversify them throughout as many different sectors as reasonably possible. And while we were going through some of the unknown and uncertainties, do you feel like our portfolios were remaining as diversified compared to what else is out there in the markets that investors could have been buying at the time?
Yeah, yeah, absolutely. 15 stocks, believe it or not, diversifies away a good 95+% of the risk that's actually diversifiable, right? So while it may benefit you in the sense of owning more securities in terms of perhaps, and it's not guaranteed, but perhaps lessening volatility over time, owning more companies has been proven to dilute your future returns over time.
Mhm.
So owning more securities can, in fact, give you a smoother ride, but it's widely believed that certainly that will take away from the end result, so to speak. So
Mhm.
what we do, we don't, Jim, right? We don't look at it as necessarily concentrated. We look at it as properly diversified.
Correct.
And it's not common to see that in our industry today. And the reason I think for that is that there are just so many investment products out there and these products all own numerous securities. But we don't. We own what is appropriate for our clients to give them the amount of diversification that is necessary to achieve their goals. And that works for us and it works for our clients.
So do you see anything changing at post-election, post we are right now with our strategy? Do you see anything changing on what we've done in the past?
There was an
And
election.
what's that?
There's an election.
Yeah, there's an election, right? So
Uh,
do you see anything changed based on what's happened over the past 10 or 11 months that would affect our strategies going forward?
no. Of course, as we talked about just a moment ago, there are things that we think today that we will think differently about a month from now, 3 months, 5 months, and that's why having the process in place before, of course, is tremendously vital. But in terms of the process operationally, how we diversify and allocate our clients' money, no, we will continue to utilize the best research we can get our hands on, because ultimately that's what's going to drive our clients' portfolios toward their objectives, and not trying to second guess near-term current events. You bring up election. I mean, that's something that's widely talked about, right? It's fun to talk about, and it's usually met with the expectation that there's going to be a tremendous amount of volatility surrounding the election. We saw volatility this year, obviously due to pandemic, but I think some of the volatility we've seen leading up to November here has been as a product of expectations on who's going to get in office and what that means and so on. But the fact of the matter is, this does die down, and what ends up pulling the market prices up are not events in the past. It's expected events in the future. Mm-hmm. We're heavily focused on where are those companies that are going to experience that great amount of positive change, and we want to invest in those companies because those are the companies that will pull portfolios forward over time. Doesn't mean there won't be any bumps in the road. No question about it. We're going to see our share of ups and downs as well. But as our strategies have worked out, we see a lot more ups than downs, and overall, things tend to work out very, very well.
Yeah, and along the same lines, we've seen some countries around the globe start to go put themselves back on lockdown with different types of restrictions. Mm-hmm. We don't know what the future holds here in the US, but let's just say we are on a lockdown, we are finishing up an election. Do you see anything with the lockdown or COVID related changing anything we do on the investment side?
No, it'll make it more interesting, right? That's for sure. I think that the main idea is that, number one, it looks like, judging from what we read, Jim, and obviously what we all see in the papers, is that we're certainly a lot closer to a vaccine today than we were back in March, right? And we are certainly better prepared from an overall systemic healthcare system to be able to deal with a surge better than we are. We have the PPP, right? The personal protective equipment in place. We have a lot of things in place now that we didn't back in when we were first dealing with this. Does that necessarily mean that we have nothing to worry about? No, not at all. We don't know what tomorrow brings. But then again, in any market environment, forget that we even went through this pandemic. If we're actually able to, there's always something, as you know, Jim. You've been in the business involved in the markets a long time. You know, it's not the things that we expect, right? It's the things that we don't expect that end up affecting the markets a lot more than anything else. So positioning portfolios, being consistent with how we operate is how I think any wealth manager, money manager has the amount of success with their clients, is that they stay consistent to the process that brought them there, that brought their clients there. And that's exactly what we do.
Yeah. No, perfect. And kind of wrapping up, because we're coming up on 3:30 here. There's been a lot of activity and conversations recently that I've had with clients around interest rates, around the bond market, around the Treasury Department auctions. And I'll just point out that we call this the No Bonds Cast. So as we wrap up, because I know you love talking about fixed income and bonds and kind of how we address that, you want to just jump into our thoughts about interest rates and market activity and how that affects our portfolios and why we do what we do?
Sure. Yeah. So any asset that you can buy, be a piece of real estate, a utility stock, anything that is correlated whatsoever, positively or inversely with interest rates, does have exposure to changes in interest rates. What does that actually mean in a nutshell is that as interest rates rise, assets that are more dependent on borrowing money, real estate, utilities borrow a lot of money, potentially can be negatively affected if they're not in a great position already. And what I mean by that is typically it's unexpected changes in interest rates that cause the most amount of concern for interest rate sensitive vehicles like utilities, like real estate. Expected changes in interest rates, especially over a little bit longer of a period of time, don't necessarily have that much of an impact, at least with certain companies that are already in great position. Just because a utility or a real estate company or a piece of real estate may be traditionally interest rate sensitive. If you own a piece of real estate where you have very little liability on it, maybe it's fixed for 30 years, well, that's not going to really affect you that much because you've fixed your rate of interest that you're paying for a long period of time. Utilities companies that are in great fiscal shape, and that while they do borrow money, they're in fundamentally a position where they pay a healthy dividend. They utilize their capital very, very well. Those companies are typically ones, real estate companies as well, are typically ones that are buffered, not completely, but buffered from these swings in interest rates because they're in such good economic condition and actually can go through these periods of time where they can actually raise their level of their dividend income that they pay out to investors, even in a scenario where interest rates are rising. So it's not one size fits all, but yeah, we are seeing things happen with interest rates. And I guess, you know, one of the things with all the talk on the news and everything about interest rates and such, I will say the one thing I guarantee I know about interest rates is that we don't know and about where interest rates are going. We flash back to 08 and 09. I mentioned this in a meeting the other day. Interest rates came down to rock bottom, and it was widely expected that over the next 3 to 5 years that interest rates will see runaway inflation and interest rates will have to be raised to double digits. I can go back to what my dad used to tell me when he bought the house that I grew up in. His mortgage broker at that time had said, and this again, for those of you old enough to and I'm not old enough to realize this, but other than looking back in history, but you know, in the early 80s, in the mid 80s, where interest rates were, his mortgage broker had said to him, you'll never see interest rates as low as this in your lifetime. By the way, his mortgage interest rate at that time was about, he said it was about 13%. Okay. So one thing that proves to me then and now is that we collectively, we can prognosticate and predict all day, but we don't know where interest rates are going to be 3 to 5 years from now. All we can do is use the information from great resources today and make the most relevant and reasonable decisions for the portfolio going forward, knowing that we're going to be wrong. And when we're wrong, we're either going to be wrong to the positive, we're going to actually think more positively about companies we own, or we're going to be wrong to the negative. That happens as well. And that's why a sell discipline in the portfolio is so incredibly important. That's why our sell discipline, when we do lower estimates, we remove it from the portfolio and we reinvest those proceeds into a company that we've newly identified as one with a bright future.
Awesome. We're coming up on 3:30. Anything else you want to add before we close out here, Ben? Any other comments you want to make?
How are your New York Jets doing this year?
Just slightly worse than the Raiders. Well, I thank everybody for tuning in. Hopefully you found this time that we've had helpful. And just as a reminder, the second Thursday of every month at 3 p.m., we're going to be continuing our No Bonds Cast. Thank everyone.